Hello everyone, what a Friday we had last week. An 8-minute speech by Jerome Powell wiped out billions of dollars from the stock market. The sell-off was relentless and it was literally a bloody Friday. And guess what? This is the sort of pullback that I have been waiting for. So in this video, I will share my interpretation of Powell's speech and what does it mean for the stock market. With this bigger pullback and as a follow-up to my last video, I will once again share some entry points where I am personally considering to pick up some shares. So do stay tuned throughout the video, alright? Okay, as usual, let's start things off with a quick recap of last week. On Friday, at the Jackson Hole Central Banking Conference, Jerome Powell admitted that getting inflation under control would come at a cost to American households and businesses, but he felt that it is a price worth paying. Here's an extract of what he has said. While higher interest rates, slower growth, and softer labour market conditions will bring down inflation, they will also bring some pain to households and businesses. He then further shared that these are the unfortunate cause of reducing inflation, but a failure to restore price stability will mean far greater pain. And other than more interest rate hikes in the coming months, Powell also hinted that this high-rate environment is here to stay for some time. Here's the extract. Reducing inflation is likely to require a sustained period of below-trend growth. In my view, I think the speech is a wake-up call for the stock market and investors. I'm not sure about you guys, but I have heard Powell loud and clear that inflation is Fed's key concern right now, and that they will remain hawkish for a sustained period as they attempt to bring the high inflation down from 8.5% to around 2%. This means people should not expect the Fed to back off or pivot quickly until the inflation problem is fixed. As a result of his 8-minute speech, Wall Street stocks tumbled, with all three main indices ending with losses of 3% or more, and 99% of the companies on the S&P 500 were down on the day. Every major sector was in the red and billions of dollars that were pumped into the stock market since June this year were erased. In terms of market outlook, it does look gloomy at the moment as investors' sentiment turned weak overnight. And to just highlight, Powell did not give any indication on how high interest rates might rise during the next FOMC meeting. But I think investors are trying to err on the safe side and expect a rate hike of 75 basis points again, therefore triggering a sell-off on Friday. Well, despite the bloody Friday, and the possibility of the sell-off continuing into the upcoming week, there are still two events that could see the market reverse temporarily again. And that is number 1, a lower than estimate CPI number which will be released on 13 September, and maybe a 50 basis points increase in the interest rate during the next FOMC meeting on 20th and 21st September. With all this in mind, my view is that the stock market will face more volatility and wild swings in both directions in the weeks ahead. And if you are an option trader, you will probably love it, provided you can identify and ride with the direction. Finally, I also thought I should highlight that coming along with the rate hikes is quantitative tightening, where the Fed will lower its balance sheet. And to put this in layman terms, they are going to pull money out of the economy, and this shrinking of balance sheet could be accelerated during the September's meeting. Alright, let's move on to the technical analysis segment. But before that, I hope you can help to smash the like button and subscribe to my channel if you have found some value in my video. Thank you. Okay, let's have a look at S&P 500 aka SPY. If you had watched my last video, you would have noted that there was a bearish shooting star on the weekly chart. And for it to be validated, it has to fulfill these two conditions. And guess what? Both were checked. On the daily chart, it isn't looking good as you can see a big fat red candle form on Friday, which clearly indicates that the entire market is in a sea of red. The selling pressure is really heavy now. Somehow, I love how this candle stretches from one Fibonacci retracement level to the other, and these two levels are 419 and 406. Anyway, again, if you had followed my last video, you will know that I mentioned I am using SPY as a gauge of the market sentiment, and when it hits 406, I will consider picking up a few shares of the companies I want. But unfortunately, at this point, the companies that I want such as Tesla, Google, Apple and Microsoft had not reached my target prices, but Google is coming very close. I will share more as we go through the individual stocks later. For the week or weeks ahead, watch out for 4064 SPY. see whether it bounces off this level to retest 419 or if it breaks below it. Key support levels on the downside are 400 aka the psychological level, 396 aka the 50 moving average, and of course 389 which is the 23.6 Fibonacci level. To add on, if SPY breaks below the 15 moving average, then the short-term trend is very bearish. And if it goes below 389, then we can kiss goodbye to the recent rally as we will likely fill the two gaps below. They are 379 and 380 as well as 369 to 370. On the upside, SPY needs to reclaim 419 and also fill the gap at 419 to 421. And to be bullish, it needs to go above the 200 moving average at 427 now. At this point, I think it's quite an uphill task unless we have a twist of events again. Therefore, if you are holding on to call options with short expiry date, you may want to revisit your trades. But of course, this is not an financial advice. Moving on to Apple, quick recap, the stock got rejected by the yellow and red trend lines at the top. And what is not looking good is that we had a bearish engulfing candle form on Friday. Looking at the Fibonacci retracement level, the next level of support is 161. As mentioned previously, when Apple was at 171, I was waiting for it to go below 160, and it seems like we are not too far away. Personally, I am hoping for it to break below the support of 161 and 200 moving average at 160. If these two levels are breached, then Apple is looking bearish. We will then have a high chance of heading towards the gap at 157 to 159. For me, I am hoping bears can push it further down to 155 as I thought this would be a good entry price for a few shares. To add on, this is also where the 50 moving average is currently at, around 154. Bulls will try to defend this area. Anyway, to clarify, I am not saying we should go all in at this price. It just means maybe we can pick up a few shares if we want. And then when it falls lower, we pick up more. That's called buying in tranches, which I have been sharing all this while. Personally, I will be more aggressive in my purchase when it falls below 150. Next, we have Tesla. It seems like it's currently floating around a mini consolidation zone between 285 and 310. And similar to many other stocks, 200 moving average is acting as a strong resistance level. On the downside, the bottom of the consolidation zone should offer some form of support, which is 285. And Tesla is dangerously sitting right above this support level. Come next week, let's see if it bounces off this level. If it doesn't, and if this 285 is breached, I don't see much support below. Well, it may seem crazy, but my view is that the next meaningful support is the 50 moving average at 264. To add on, in the worst case scenario, we may fill the gap at 250 to 254. But do note that there is no guarantee the stock will slide to these levels. And even if it does, it may not happen next week. Nonetheless, personally, I think these two areas are good entry zones to snatch a few shares. On the upside, check out the long red dotted downward trend line. Tesla needs to break above it to turn the trend from bearish to bullish. And yes, we have a long way to go as we are looking at 340s range. Okay, moving on to Google. Well, for Google, how predictable can it get, man? The stock is just following what I've shared in my last two videos, moving in a zigzag pattern and get rejected every time it hit around 120 range. Look at the chart. At one point, it tried to break above 120 and was trading around the supply zone for a couple of days. And no price for guessing it right. It went back down again. So if you are an active trader, I think you will love this predictable pattern up till now. At this point, I am not sure if we will continue to hit further down to sub 100 range just like the other 4 times. So let's see what happens next week. But looking at the chart, it seems like the gap between 107 to 108 will act as a magnet to pull the stock to that range. Anyway, as per my last video, I am waiting for it to hit around 105 and I may enter a little bit. To highlight, 100 is a huge support level in my opinion. As a result, I actually sold a put contract with 100 strike price expiring 30th September. This means I am of the view that Google should not fall below 100 by 30th September. But, yes, there's a but. The caveat is, I can be wrong, and so I am prepared to collect 100 shares of Google at $100. Therefore, please do not follow my option trade blindly if you are not prepared to hold 100 shares of Google. Alright, now let's take a look at Microsoft. Last week, when Microsoft was at 286, I shared that if the market wants to fall, the downside is quite a fair bit as the next meaningful support is at 270. And here we are, Microsoft is at 269. Interestingly, the 50 moving average is at this level too, around 268. There could be some possibility for it to bounce from this level. With that said, if the overall market continues to react negatively to Powell's speech, then the 50 moving average may be breached and that will be bearish. Anyway, we are now at this consolidation zone between 240 to 270. For patient investors, you may want to hope for Microsoft to fall further so that you can pick up a few shares at the lower end of the consolidation zone. Personally, I am eyeing 250s and maybe 240s range. Let's hope it get there. Here are my end thoughts. As I have always been sharing, the macro environment is still very weak, inflation is still very high, and that I was not convinced by the rally we had for the last 2 months or so. I also shared that the rally was built on sentiment and false hopes that Fed is going to pivot. So now, when the Fed hinted that they will remain hawkish for a period of time, the market plummeted in a waterfall way. I'm not sure how many investors or bulls were trapped at the top. You know what? The scary thing about such sentiment rally or bear market relief rally is to make you think the bottom is in and create FOMO in many investors, causing them to chase the highs. The saying that the markets take the stairs up and the elevator down may seem overused, but it is still true in today's context. I mean, the stock market literally just wiped out almost all the gains we had in August. Once again, this huge move down served as a reminder to all of us that we are far from the clear as we are still in the woods. Remember, the stock market is still weighing the risk of inflation, recession, and the Fed rate hikes. The market is still under massive pressure. Here is another old saying, don't fight the Fed, so do keep this in mind as well. In my opinion, macro factors and Fed's monetary policies outweigh companies' fundamentals. But this does not mean that we stay out of the stock market when the macro environment is weak. In fact, if you are young and time is on your side, you should probably be excited about bear market because it presents a good opportunity to average down on good companies at a discount, which will in turn increase the chance of your ROI over time. Alright, that's all for this video. If you have learned something today and found my content useful, please help to hit the like and subscribe buttons. Thank you very much.